What is going on, everybody, and welcome to the Hardcore Mortgage Podcast that's brought to you by Capital Mortgage Funding, which is also powered by Fairway. MLS number 2289. We are an equal housing lender, and we have an all-star panel with us. He's actually, and we have a great guest. It's no stranger at all. But before we get into our special guest, let me go around to our rock stars. We got Miss Lisa Lawson, always holding me down. We're gonna not let her speak too much because her voice isn't all that great, and we're gonna save her for Saturday. But we got Mr. John Kolb, my fellow top 1%er.
What's up, guys? How you doing today? Happy Thanksgiving, belated.
Yeah, a lot to be thankful for, I think. And then we got my co-host, Mr. Harvey Freed of the Hardcore Mortgage Show, that's always holding us down every Saturday morning on 97.1. What is up, my man?
Hey, good morning, everybody, especially you, Becky. Always got that positive vibe going.
Yeah, we have so much to be thankful for, and I'm actually really thankful for our guest. He makes our job extremely easy. He's no stranger to the podcast. He's no stranger to the radio show, and he's definitely no stranger to real estate. He's literally a pioneer as far as how he handles his clients. He doesn't take off more than he can chew, especially because service is everything for him, and that's something that I really admire about our guest here. So without further ado, Mr. Matt Bush from RE/MAX, welcome.
Hey, thanks, guys. I think this is my first time on where there hasn't been snow outside, so we're going to try to hope that continues.
Isn't that weird how it kind of works out like that, where sometimes it's like the seasons happen and it's just coincidentally you're on like every time it's snowing?
Yep.
It's weird. I mean, I'm taking the mildness that's we've experienced. I got out there, got my Christmas lights up, and this was my first year actually in a while that I didn't procrastinate to the point that I'm putting up my Christmas lights when it's snowing. So snaps for me.
Nice job, Becky.
All right. Well, I want to get into it. I read about some stuff. I know the Fed, we talk about rates a lot. I just want to get that out of the way. We actually were talking about that a little bit before we kicked it off. The Fed is supposed to meet again next week, and they're going to be analyzing again inflation data for the month of November. Everything is behind. We had a good decrease in rates compared to where they were once we had the consumer pricing index came out and they saw inflation, decrease a little bit. So they are rumored to be possibly doing, maybe another 0.5 basis points increase to the rates. But the reason why I'm bringing this up is because it's very important for our viewers to understand that doesn't necessarily mean that you're going to see a spike in interest rates for mortgages. We talk about this a lot, but I feel like you can't talk about it enough because it's very important for people to understand. And John can, back me up on this, that interest rates do not follow what the Fed is doing necessarily. Is that correct?
That is correct. The Fed obviously has a direct influence on the index, but it's our rates do kind of follow it at times, not all the time. What we've learned a lot is that interest rates follow inflation a lot. So the Fed has artificially made interest rates low since March of 2020, and since then they've had to start knocking them up a little bit because of inflation and trying to curb that inflation. Now we have sat through a bunch of presentations, a bunch of seminars of how the Fed should have done this, maybe to ease the tensions and not put a halt to the mortgage and purchase market. But once again, they haven't done that, but that's okay. We're going to get through it. We're starting to see a little bit of ease on the economy. The inflation numbers aren't as bad as everyone thinks. Like Becky said, the CPI was a little bit better. So that caused our rates to come down a little bit. So we'll see what happens when they make their move next week. I think we're all in agreement that they will raise the rates another half point. And hopefully that's already built in, so we won't see much of a movement at all, and maybe even another downward shift.
Yeah, I actually agree with all of those things. Wholeheartedly, I do feel that we're going to see a little bit of a press back on rates, but what people need to understand is the rates should have been higher in 20 and 21. The reason why they weren't is because they were artificially deflated, so that's why it seemed like it was a lot. But the Fed, I do feel like they did a little bit too much, and now we're seeing a little bit of a settling, which is awesome. But the experience, though, and it kind of goes into this market, and I want Matt to jump in this conversation, the shifting market or the shifted market, right? The experiences that people had in 20 and 21, we have already established those experiences are not going to be those of the buyers right now. And where I need an answer. I actually want to hear everyone's opinion on this is right now, this market isn't just one thing. Okay. It's not a seller's market. I mean, technically, if you're talking inventory, it still very much is a seller's market, but it isn't just one thing. It is a little bit of a buyer's market. It's a little bit over asking, it's concessions, it's a lot of things, which is kind of cool. But at the same time, this has been more of a buyer's market than we have ever seen in the last several years. So why is it that people are hesitating to buy in a buyer's market versus they were jumping and throwing themselves in front of the moving train over a seller's market? Obviously, we know rates, set that up, because it was a good, you're getting free money. However, I feel like there's some real serious opportunity right now. What do you think about that, Matt?
Yeah, and I don't know if I'd go with buyer's market. I think I prefer the term borrower's market right now.
Ooh, I like that.
Sellers and banks are both getting creative on how to put buyers into loans now. Not that there aren't any less hoops to jump through. We still have to make sure that you have income. We still have to make sure you have credit. We still have to make sure that you're a qualified buyer. But sellers know that this isn't 2021 where if you're basically breathing, you're getting a loan. There aren't a million buyers out there fighting tooth and nail over a house. So buyers or sellers rather are recognizing that the rates that are coming up. They're willing to help buyers buy down that rate to where they can get into a house at a still an affordable situation. If we can there's still opportunity to get a buyer into a house for less than they're paying in rent. So where that's still the case, that's still working out. And with the different rate programs, with the sellers now, instead of saying, I demand you give me an appraisal guarantee, the shoe is so much on the other foot. The sellers are giving buyers, hey, we're going to give you concession guarantees to make sure that you do qualify for this loan. We do get you this house. We do get our check at the end of it. And that's where it really matters on who you work with. So you have competent agents on both the listing side and the buyer side who know the programs, who know the market, who can navigate from either a first-time home buyer or someone who hasn't bought a house in a while, as well as a seller who probably hasn't sold their house in a while, and they don't know what rate buy downs are and 2-3-1s. They think that's some area code that people are talking about that nobody gets. So it takes skilled professionals to navigate through this intricate market to make sure that both parties are getting what they want, because it's still very much a possibility in this market.
Yeah, I really like what Matt just said. He brings up a couple of really good points. One being that there are so many opportunities for buyers to work with sellers to get into the home for as cheap as possible. And because we're coming off of a very good spring, summer, which we can still use those values, the values should be there to allow that to happen. So my point being that, like Matt brought in, you got the 3-2-1 buy down, the 2-1 buy down, or the 1-0 buy down. And those programs are fantastic for people trying to get in who think that the rates are going to come down in the next year or 2 or 3. Because the good thing about these programs is that if you refinance next year and you're on a 3-2-1 buy down, you've got all this extra money in escrow. That extra money then goes to apply to pay down the loan, pay the closing costs when you go to refinance. And then all of a sudden you had that 4% interest rate for a year, 5% interest rate for a year, then your 6% interest rate for a year. If you never got to that 5 or 6 point, you had 4, we refinance you, bring it back, you use the money that's left in escrow to pay the closing cost on the refinance, boom, all of a sudden you're at 4% for the rest of your loan, assuming that's what happens. So great points. Let the seller work for you. Let the values work for you. And I think Matt's got more to say.
Yeah, and I think the way I'm trying to think about it is this. If you buy a house that needs some updates, right? It hasn't been updated since the 80s or the 90s, your typical first-time house. Let's say you get one of these rate buy down programs, you get into it because the seller's also offering your concession. So you're basically getting in for about 5%. If I do work to update this house over the next year to 2 years, in 2 years when I refinance the house, I'm going to refinance it. I'm going to take money out. I'm going to drop my rate. I'm going to get rid of my PMI. And all of the money that I used to buy the house, like down payment, all the money that I used to fix it, I'm basically getting it back in rate reduction and cash out. And basically right now, if you buy a house and wait 2 years, you're almost getting a house for free, because all of the money that you're putting into your house, be it for the down payment or the updates, you're going to refi and get that money back, and you're going to get a lower rate. So it might be scary because people see that 6s, that 7s, that 8s, but there's a way to keep you in that 5s. And there's a way, if you talk to a skilled banking professional, to put you on track to, hey, these are the things that higher value houses are going for in the market. These are the finishes we're going to put you in. And then when we see that you do those updates and you qualify for a better interest rate, we can take that money out, apply it, like John said, to the loan, then your PMI is gone. So not only are you taking money out, you're putting it in your pocket, you're saving your money on both the PMI as well as the lower interest rate. I just did this with a client that just bought a house in Westland. We bought a house for $168,000. The house appraised at 203. So it's already at 83% of the value. He's going to refinish the floors and do a paint job. And next summer, he's going to refinance. When we think the rate's going to be closer to the fives, he's going to drop from a 7.25 to something in the fives. He's going to get rid of his PMI. It's going to save him $300 a month. And he's going to get all the money back that he already put into the house.
Yeah, I listen, the biggest thing that you're saying right now is that, and I feel like a lot of people lack that, is the vision of looking down the road. Okay. I feel like we are really, really good here at Capital Mortgage Funding, and we align ourselves with the right people where we're not just looking at what is right in front of us, that immediate, gratification and reward, right? We're going to get you in the house. Yes. But the programs that we are always looking and analyzing is to set you up for success down the road, 3 years from now, 5 years from now, right? There's no crystal ball, but at the same time, we can't put you in a tough position now, because then you're not going to be set up for success down the road. And I feel like there's sometimes lenders, they get caught up in that one mindset, like FHA all day long, or 3-2-1 buy downs. And that doesn't work for everybody. Like a 3-2-1, 2-1 buy down, 1 buy down, that works specifically for someone that already has funds on hand. And we all know that sometimes that's not the case, right? But at the same time, it's looking down the road. What do you have right now? What can we do to fix those things with credit? And I think it's a great question that I wanted everyone to answer, because even just for me personally, I spoke to a first-time buyer yesterday. And he was like, everything I'm seeing, I think it's better if it's the rentals. Like, the rentals look better to me. And I started laughing, and he's like, what are you laughing about? I go, well, that's because they want you to see the rentals as better, because they've already put the lipstick on it. They've already painted the walls. They want to entice you to rent from them versus invest in yourself. So yes, if you are looking for a house for yourself, you might have to get, as we call, grandma's house, right? It might need to be a little bit of a fixer upper. You might need to invest in some paint. However, that's going to be your paint. That's going to be your colors. Those are your things. So don't get fooled by, oh, well, this $1,200 lease over here is great because I don't have to do anything. Okay, cool. Well, you also don't get anything out of it either. And it's important having these conversations with people and our clients to make sure that everyone understands that 6% rates is very affordable. Isn't that right, Harvey?
1,000%. And it's just that education piece that's so important, whether you're working with you'll know quickly if you're working with a great lender who's been around and has a track record, and a great real estate agent that could sort of look down the road, like you said, Becky. That's the important thing. See, the real deal is the best marketing lenders in the United States are the worst lenders in the United States. So that's the trick right there. And without throwing any names out there, sometimes people are being marketed into a debacle. And we've seen it. We're getting the quotes, we're seeing the loan estimates, and we just want to urge our buyers so that if they can sit down and hear a second opinion, definitely call us here at Capital Mortgage. And then that's the key. It's just sort of wrapping your head around it. I just got off the phone. And again, we're comparing apples to apples with other lenders. And I think it's that education piece is so key.
Yeah. And I know, like, oftentimes I'll even be willing to look at an estimate, whether they use me or not. There's no pressure, because I'm not here to sell anyone. I'm here to actually help. And I know everyone feels the same way. Whereas I'll look and say, hey, this is a really good deal. I like, you should take it. It looks legit. Or this is horrendous, and walk the other way. But the problem is that people don't understand. And what Harvey just said is so true. Sometimes the people that are marketing the most really have no idea. And, to Matt's point, you can be experienced, okay, but then you can also be completely out of touch and not have any idea what's going on. I mean, the point is that you need to make sure that you're in line with people that are in the mud with you, willing to get in there with you. But how do you get that across to our consumers that don't know any better? How do you, and that's where sometimes I feel like we rely on our referral partners, because, people get confused. Buyers there's so much information out there. So if everyone's got the same programs, everyone's got the same rates, everyone's got the same everything, what's the X factor? Well, it's you as the person, and it's like, and that's really what you have to kind of approach this market. And, I feel it's a disservice if people are not speaking to me or us at Capital Mortgage Funding, because I feel like a lot of people leave money on the table so much.
Right. Becky, you're 100% right that it's the X factor is, has to do with how to get a loan done, right? And staying in touch and being in tune with what's going on in the market and how to get loans done is the most important thing. I've been doing this it'll be 26 years in March, even though Harry can't get that right. He always says I'm 20 years, right? But
No,
26
Papa
years-
Harvey's not, or Papa Harry's not here. He can't defend
Oh
himself.
yeah, let's keep talking about him. But you know what? At the end of the day, when it comes down to it, we all have files that have little hiccups in it. And it's about how you get it done to make sure you're still meeting Matt's closing date expectations, because Matt is also our client / partner to get this done. And we got to make sure that we're doing everything we can to get the client in as expected. And, hiccups happen, and it's how you handle those hiccups, the team around you that works with you to get it done. And that's what is the X factor for us, is that any one of us can step in for the other person. Corporate will step in and help. Harry will step in and help. Harvey, Becky, Lisa, and to get loans done, because it's all about the good vibes out there about Capital Mortgage Funding and our referral partners.
1000%. I'm all for that. And I feel like, and another thing too, is like, I wish Lisa could speak, but even just your FHA, things are getting tougher for FHA. If you have delinquents on your student loans, you might not get an approved eligible on an FHA transaction. So if you're an FHA buyer, that used to be a real easy vehicle, and they've kind of tightened up those reins a little bit. The reason why we know that is because we see it every day, and we're having to pivot around certain things within the automated systems. And if someone doesn't have additional money set aside, and what that means is, let's just say if you had to bring $5,000 for closing, that's everything out the door. But maybe we need to see that you have an extra $2,000 in your bank account, so you're not being completely depleted. If you don't have that, that might be the difference between a smooth underwriting process, or we're driving a stick shift for the first time all the way across the finish line, and we got to throw you across there. And it's knowing and having that expertise to get across that, because it's, definitely things are changing every day in this market on our side of things. And it's important for our consumers to know that, we always have their best interests at heart, for sure.
Becky, what's a stick shift?
I don't know how to drive it.
Becky, wait, you can't drive a transmission?
I haven't drove a stick shift in so long. I would be grinding the crap out of that transmission, but I'll do it. I'm all about yes right now. So if it's going to be an opportunity for me to learn, we're going to do it together. Just like sometimes in mortgages, we got to literally put everyone on our shoulders, and we're going to just do it together. Yep. So for you, Matt, from what you're seeing, I want to know, what has been the biggest shift for you in the recent months? Okay, what's been your biggest objection with buyers, that are maybe entering the market, or even sellers, looking to sell, and how have you been overcoming those? Because I feel like it's the same questions over and over and over that get kind of thrown at us. So what are the things that you've been hearing or seeing, and how have you been overcoming that for your clients to, get them success?
So I'm seeing two things, and one's industry and one's kind of market. So, market, I'm seeing people that are owning, they don't want to sell to buy, because everybody I know that is a homeowner refinanced between 2020 and 21, and they got down to the super low 2s into the 3s. So, it's having probably, even if they were talking to me 2 to 3 years ago about, hey, Johnny's freshman in high school, in 4 or 5 years, we're going to sell the house because we don't need this, $3,000 or 3,000 square foot place. We want to go find that ranch. Well, now they're going to stay in that, 3,000 square foot house a little bit longer. Not that they need it, and not that they like cleaning anymore, but because they got that, $500,000 house now at 3%. So to go down to something that's going to be their equivalent, something 2.25 at 8%, they just can't swallow that, regardless of what we're telling them. The other thing that I'm seeing is, I'm beginning to see on my end a reduction of agents already. So I'm seeing more agents pack their bags and go home. I've got a couple of listings, and in our system, when you put a listing live on the MLS, you can see agents who have clients that have seen your listing and who have expressed interest in your listing. And I have called, I've emailed those agents, and it'll go to voicemail. Calls, emails don't get responded to. So I've seen agents who think that, they might have got into this in 2020 because I can go to real estate school from the couch. I can show houses from the couch. and there's almost no adversity because I just have my friends and family call me if they need me. And now those same people have maybe a small book of business that want to act, but they're not, when I reach out to them, hey, you've got a client that's favored in my house. I've got a motivated seller. You've got a motivated buyer. We'll do anything to get you in this house. Calls go unresponded to, text, emails. So they've got a buyer there that doesn't know that there's a seller that's willing to give them whatever they want to get that house off their back. And they're not getting responses from their agent because they've probably gone to selling Avon or Tupperware or Cutco, whatever Kirby vacuum is hot at the moment, because this got too hard or too complicated or too confusing, too extreme. So that's the biggest issue that I'm really seeing is buyers or sellers have hitched their wagon to somebody that's not full-time with it, who doesn't know how to navigate what's going on. And they're not saying, hey, I get where you're at, but hey, we can buy this house for only, $1,000, even though your mortgage is going to be $1,500. Let's get you a right buy down. Let's get you some seller's concessions so you don't have to come out of pocket that much to close.
I'm actually really, really, really glad that you brought that up because it actually was on my things and you brought it up for me. So to that point, there is a huge stat. 30% of the agents are going to be gone. And that's probably, that's probably even being generous actually, or not as generous, but 30% of agents that are in the market right now are going to be gone. And what does that mean? 10% of agents are going to dominate the market. And that is going to separate. We're in this huge separation. It's almost like when, as mortgage lenders, we all had to get licensed and it eliminated a lot of people. I lived for that moment because it really separated those, it creates that separation like people like yourself need, right? And it's such a disservice. And our industry, anyone that got into the market or the industry because they thought it was easy, okay, well, congratulations. Now you have to put on your big boy pants or your big girl pants because this is not an easy industry. It's saturated. It was overly saturated. But in these moments where people are going to get weeded out, I'm living for them because it creates opportunities for you, Matt, specifically, or any agent out there that's worth their salt, because they're going to be the ones answering the phones. You guys are going to be able to take over that territory. And that goes to the point, even on the lending side. I know Harvey gets so fired up about it, right? Because there's so many bad people out there that are doing a disservice to their clients, right? And you have people that are willing to get offers accepted, but they can't answer the phone because they're doing it part-time or they had to get out of it, but they're still in it, but they're out of it. And it's unfortunate, to be honest with you. And as far as the other thing that you brought up, people are holding on to these houses artificially. Why? I feel like so many people bought houses over the last 2 years for FOMO, and they bought houses that they really didn't even want. They just wanted them because someone else wanted them and they wanted to win. And I feel like some of those people right now, like you're talking about, they want to right size, but they're holding on to this higher house, this higher payment, all the things because the interest rate sounds scary to them. And I want everyone, that's listening to our podcast right now, know that what is the price point for a house that you truly want? What are you going to pay to miss it? Are you going to continue to pay $1,000 more on a mortgage just because the interest rate looks cool? Or you're going to right size your house for the house that you want, that you're ultimately going to afford, and refinance your own leisure and be in control of what you actually are buying? Yeah. I just need to know that.
Yeah. Again, if let's say you're downsizing, you're an empty nester, you're downsizing from that 3,000 square foot house. Maybe you buy a house that's a little bit uglier, not necessarily a grandma's house, but definitely maybe a bachelor pad or something that's not as nice as what you bought. If you're putting 5% down, you're going to refinance it in a year, 2 years, you're going to get that money back. You're going to get rid of your PMI. Your payment's going to go shoot down. And then you can, if you're used to putting like $1,800 into your mortgage, you can start putting, you drop it down to $1,400. You start putting $400 a month in your IRA or your retirement. You keep paying that $1,800, but you put it on leisure, you put it on travel, you put it on your investments. So it's just one of those things there's just not enough people that out there educating, and people are so kind of in their bubble. I almost feel like I got to tell my millennials to stop being boomers. 3% interest is only like a blip in the radar. We're acting like boomers, I got to get my 3% interest or I can't go buy a house. It's that's not real, millennial. Stop being a boomer, realize what's actually going on in the market, see how you can be successful, and figure out how you can buy a house just like you can figure out how to make a Starbucks run for half the price too. You can figure this out. Let's do this.
Yeah, I love how fired up you get, because I get real fired up about that too. And, I feel like it takes double negative, right? People are going to absorb negative over positive. And I feel like we can't say this information enough, because there's just, people are following the wrong Pied Pipers out there, and they need to kind of do what's best for themselves, for sure. What do you got to say, Harvey?
I just got a little bit to say on the positive note. The fun part of being in this industry is the communication. It really is, is the relationship. And that's what makes our industry really fun and exciting. Shame on anyone who doesn't return phone calls in our industry. And then on a positive note, Fannie Mae and Freddie Mac, of course, increased the conventional conforming loan amount. And it's not so positive on that side, because our rate jumbos are just good, really. But our FHA loan limit now will be $472,030. And if you had a bankruptcy or foreclosure in the past, this could be the door that opens you up into that dream house you were looking for. Again, maybe your situation from 4 or 7 years ago was really bad, but things have changed, and we're here to help you. So that's some good stuff.
Harvey's making the announcement before FHA even has. He's going out on a limb.
I feel like we're pioneers in that. I mean, we were like originally, we were kind of teetering at the 715 mark for a conventional loan limit. So now it's at 726,200 is going to be the official new loan limit. And what does that mean? That means that we are still in appreciating market. That goes back to what Matt was talking about earlier. When you're buying homes today, you're still in an appreciating market. So that means that the same house this time next year is going to cost more for you. Do not continue to rent if you are so inclined or have the ability to purchase your own home, because that investor sees that opportunity. And that investor is going to gobble up all these properties that a first-time home buyer wouldn't actually do. So if you're not out here throwing your hat in the ring, you're going to be stepping into someone else's house. And, to start the conversation, because if it's not right now, let us help you decide when. Pre-approval is free. If you're talking to someone and they're asking you for money for a pre-approval, hang up the phone and reach out and call Capital Mortgage Funding or anyone else out there that is not going to ask for your credit card for a pre-approval. It is free. We will educate you, and we will also give you a roadmap on what you need to do in order to purchase a home successfully in the future.
And Becky, if someone's already called a bank, how many times can they talk to a banker to get their credit pulled without it negatively affecting you? If I've already called a bank, they've already pulled my credit, how can I call you still and not have another negative inquiry? What's my time frame? What's my limit over on that?
Yes, I would not recommend more than 3, because sometimes when you talk to too many people, it gets confusing and there's too many, it muddies the water. But I would, if you've already spoken to someone and you did not catch a good vibe from them, you have 45 days to have your credit pulled, and it counts as one hard inquiry, because a mortgage inquiry is completely different than you going to Lowe's and Home Depot and shopping for a 0% credit card. Mortgage inquiries are considered you can do it one time within 45 days. After that, it will be another hard hit. So don't be afraid to make the phone calls, but don't make too many phone calls where you're like, what's your rate? What's your rate? What's your rate? And, because then someone eventually is going to tell you what you want to hear, not what you need to hear. And then you're doing yourself a disservice. So that is that's my little tidbit right there. But we are at the end of our show. So I want to do a round robin. Any final thoughts? So we'll start with you. Lisa, do you got anything to say?
You guys did a great job. You said everything I would have.
Poor little baby voice. All right, what you got to say, John?
You know what? Happy belated Thanksgiving, everyone. Let's keep it safe. Get out there, do smart things.
All right, Harv.
The buyer's windows over the next 3 months, maybe. Dive in, give us a call, get that approval. Let us hook you up with the great real estate agents that we're teamed up with, and make home ownership really fun and exciting.
All right, Matt, what's your final words for today?
Who you work with matters. And if you have concerns and you have a professional agent or lender, they will address those concerns head on with you, explain a way where you can be successful and alleviate those concerns. Because just like Harvey just said, there's ways to win in this market. They just aren't out there in the open for everyone to figure them out. So when you approach someone who knows what they're doing, they'll give you a step-by-step guideline for you to be successful.
I love all of that. And you're absolutely right. It is an experience, but your experience is not the same as someone else's experience that bought a house. So make sure you're aligning yourself with people that are going to go on that journey with you. They're not going to be bystanders. They're actually going to be witnesses, and they're going to be there to help you achieve those results. Someone like Matt Bush that we are always in line with, because he does embody the same caliber of ethic ethics and compassion and empathy that buyers are going through right now. So definitely reach out to him, and you can catch him this Saturday on the Hardcore Mortgage Show. We're going to be live in studio 97.1 from 9 to 10 a.m. Me and Harvey are going to be in the studio. Lisa, hopefully she gets her little baby voice back because she always has amazing fire things to say. We appreciate you guys joining us on the Hardcore Mortgage Podcast. And that is a wrap, y'all. Thank you so much for tuning in.